Pause here. Forget indicators. Forget strategies. Forget opinions. Ask yourself one question. If my best idea turns out wrong, does my portfolio survive without panic? If the answer is no, you are not investing, you are predicting. And predictions break under pressure. One irreversible insight. Title: Markets reward humility, not brilliance. Here is the insight that permanently rewires your relationship with markets. The goal is not to predict the future. The goal is to remain solvent across many futures. Markets don't care how smart you are. They care how exposed you are to being wrong. Once you internalize this, you stop chasing certainty. You stop arguing with price. You stop needing to explain everything. You begin to think in ranges instead of targets, scenarios instead of stories, probabilities instead of promises. This is not pessimism. It is realism, and realism compounds quietly. Prediction thinking asks the market to validate your intelligence. Probability thinking asks you to respect uncertainty. One feeds ego, the other feeds longevity. Markets have existed longer than any forecast. They will outlast every confident call, including yours. The first step to real investing is simple, but brutal. Stop trying to be right. Start trying to survive. One of the most seductive lies in investing is this sentence: I was right, I was just early. It sounds mature, it sounds patient, it sounds like wisdom earned through suffering. It is none of those things. In markets, time is not neutral. Time is a force that either works for you or against you. Being early is not a cosmetic error. It is a structural failure. Because while you wait, capital is immobilized. Opportunity cost compounds quietly. Alternative probabilities disappear. Psychological rigidity sets in. The market doesn't just test your thesis. It tests your staying power. Prediction-based thinkers assume time will eventually validate truth. Probability-based thinkers understand something harsher. If the thesis requires too much time, it may be correct and still uninvestable. Markets reward alignment, not righteousness. Most investors say they think in probabilities, but almost none of them actually size their positions based on probabilities. They speak about uncertainty, but bet as if they know the outcome with certainty. This contradiction is deadly for portfolios. Position size is not just technical. It's a philosophical confession. Your true belief is not what you say in interviews or conversations. Your real belief is revealed by what you're willing to lose through your investment positions. Probability-based position sizing starts with one serious, non-negotiable premise. Being wrong is not rare. It is the default. This core principle leads to 3 hard rules. First, no single investment idea should matter too much. If one position can emotionally or financially destabilize you, it already violates probability logic. Second, losses must be absorbable, without causing damage to your self-identity. If a loss feels like a personal verdict, the position was simply too large. Survival always outranks precision. A smaller bet that you can hold for a long time is better than a perfect thesis that is fragile and could destroy you. Professionals don't focus on maximum gains. Instead of asking, how much can I make? Professionals always ask, how many mistakes can I survive in sequence? Because in investing, a sequence of losses can destroy portfolios, not single errors. Thinking about survival is key to probability-based investing. Prediction thinking seeks closure. It wants a clear ending, a definitive winner, and a resolved story. In contrast, probability thinking avoids closure and seeks optionality. Decisions that don't lock you in, exposure without obligation, and upside without existential commitment. This is why professionals love staged entries, partial exits, asymmetric setups, and incomplete information. They're not indecisive. They are deliberately non-final. Because finality is fragile in uncertain systems, and true flexibility is a strategic advantage. Once you adopt probability thinking, your questions change. You stop asking, is this right or wrong? Instead, you start asking, does this decision preserve my freedom to respond? The ability to adapt becomes your top priority as an investor. Freedom in investing is not cheap. Markets reward those who are willing to pay for optionality and flexibility. Maintaining the ability to respond, adapt, and survive unpredictable changes is more valuable than being right in any single situation. Stop reading for a moment. Ask yourself, without spin, if this position goes against me significantly, do I already know my response? Not what you should do, not what sounds disciplined, what you will actually do. If the answer is vague, you are not managing probability. You are outsourcing hope. This is the insight that separates survivors from casualties. Markets do not destroy investors for being wrong. They destroy them for refusing to adapt. Error is normal. Rigidity is lethal. Prediction-based investors defend narratives. Probability-based investors adjust exposure. One clings to explanations. The other responds to information. Once identity attaches to a forecast, adaptation becomes humiliation. Probability thinking removes that trap. It allows you to say, this no longer has edge. Conditions changed. I don't need to be right. I need to remain functional. That mindset feels unsatisfying to the ego and incredibly profitable to capital. Prediction promises certainty. Probability offers longevity. Prediction feels bold. Probability feels restrained. Markets don't reward boldness. They reward those who stay solvent long enough for randomness to favor them. The most dangerous phrase in investing is still, I'm sure, and the most powerful one remains, I don't know and I'm prepared. That is not hesitation. That is mastery. Prediction thinking rewards confidence. The more confident you are, the more persuasive you sound, the more attention you get, the more you trust your own narrative. But confidence has a hidden cost. It encourages larger position sizes, emotional attachment to ideas, resistance to contradictory information. Slowly, prediction becomes identity. You are no longer holding a position. You are defending a belief. At that point, the market is no longer information. It becomes an opponent, and markets always win those fights. Probability-based investors never ask what will happen. They ask what could happen and how often. Instead of a single forecast, they imagine a range of futures. For example, this asset could fail completely. It could stagnate for years. It could perform moderately. It could outperform expectations. Each outcome carries a probability, an impact, a survivability test. The decision is no longer about being right. It becomes about remaining functional across outcomes. This is the first irreversible shift. Every investment decision can be reduced to one equation. Expected outcome equals probability times impact. Prediction thinkers obsess over impact. If this works, it's a 5x. This could be life-changing. Probability thinkers focus on the other side. How often does this actually work? What happens when it doesn't? A decision with massive upside but catastrophic downside is not intelligent. It is irresponsible. Markets don't reward bold forecasts. They reward decisions that survive error. Here is a truth that feels counterintuitive. Improving forecast accuracy does not guarantee better returns. You can be right too early, be right with too much size, be right but unable to endure volatility. Forecast accuracy feeds ego. Survivability feeds capital. Probability thinkers assume forecasts will be wrong often. Information is incomplete. The world will surprise them. This assumption leads to smaller bets, flexibility, patience. Ironically, accepting uncertainty produces more consistent outcomes. Portfolio construction is not the same as diversification. Most investors misunderstand what diversification means. They think it simply involves owning many assets, spreading bets evenly, and reducing volatility. That is only a surface-level definition and misses the real intention behind building a portfolio. Probability-based investors construct portfolios very differently. They ask challenging questions, such as, what breaks in inflationary regimes? What survives liquidity droughts? What benefits from chaos? What remains functional when popular narratives collapse? A real portfolio is not just a collection of attractive ideas. It is an architecture of resilience. While prediction-based portfolios are coherent, appealing stories, probability-based portfolios are controlled disagreements. They are intentionally designed to survive uncertainty and withstand shocks. Probability-based portfolios assume certain outcomes. Some positions will disappoint, some will stagnate, some will surprise. Importantly, this is not considered a failure. It is a core part of the design. The portfolio is structured to incorporate both successes and disappointments. The objective is not to eliminate uncertainty, nor to map out a single outcome perfectly. The real goal is not to depend on one possible future being correct, but to build a system that remains functional regardless of which scenario unfolds. People often mistake emotional neutrality for indifference. Observing experienced investors, many assume they do not care anymore, or they have lost their passion. In fact, the opposite is true. Experienced investors care deeply, but not about simply being right. Probability thinking fundamentally changes how outcomes are perceived. When uncertainty is expected, losses become feedback, wins are recognized as temporary, and surprises are accepted as a normal part of investing. Nothing in the market feels personal for those grounded in probability. This is why veteran investors do not celebrate loudly, do not defend their positions aggressively, and do not engage in heated arguments about forecasts. They are not disengaged, they are unhooked from attachment. Unhooked is the only sustainable emotional state in markets. The most expensive sentence in investing is not, "I was wrong." It is this, "I know what will happen next." The moment you believe the future owes you clarity, the market starts charging interest. Most investors enter the market with the wrong mental contract. They believe investing is about finding the right answer, making the correct call, predicting what comes next. This belief is reinforced everywhere. Analysts publish forecasts, economists debate scenarios, media rewards confident predictions. From the outside, it looks like a competition of intelligence. Who is smarter? Who saw it first? Who called it correctly? But markets are not classrooms. They don't grade you on correctness. Here is the reality most investors never fully accept. The market does not reward people who are right. It rewards people who are still alive when randomness ends. You can predict correctly and still lose money. Right thesis, wrong timing. Right direction, wrong size. Right idea, wrong risk. Prediction thinking assumes a fair world. If my analysis is good enough, outcomes should follow. Markets are not fair systems. They are probabilistic systems, and probabilistic systems punish certainty. Let's dissect why prediction thinking fails at a structural level. Prediction thinking assumes a single future. At its core, prediction thinking rests on one hidden assumption. There is one future, and my job is to guess it correctly. Everything follows from that. One dominant scenario, one main thesis, one right outcome. This creates a fragile mental structure, because the moment reality deviates even slightly, the entire framework cracks. Markets rarely move in straight lines. They move through delays, overshoots, reversals, regime changes. Prediction thinking cannot tolerate this. It was built for certainty, not variability.